Hello, everyone. Thank you for joining us here today. Let's kick it off with just a very general question on what has been driving the growth in embedded finance from your perspectives. Is it because businesses can easily integrate it into existing services in a very agile way because it's powered by API-based platforms? Or is it consumers who are shouting for more convenience and personalization? Rob, let me kick it off with you.
Thank you. Thanks for having us here. Look, it's a combination of all of them. It is mostly driven by consumer preference, or in our case, small business preference, who are not keen to queue up at a bank for a few weeks to get a loan, or not wanting to wait for high credit card fees coming through or rolling them over. So we see over the past 8 years that we've been running Liberi as a small business finance platform, embedded finance platform. We've seen a massive shift away from the big lending banks to alternative finance, and that is purely the availability, it's the speed, it's the dealing with the ecosystem of small business and not having to go separately speak to your bank. That's a big driver of that.
So you say consumers, David?
Yeah, I think the one thing that we know about the sort of traditional banks is the quality of the consumer experience, or the sort of application layer, is pretty weak, right? And that's reflected in the Trustpilot scores of every major bank. Whereas people have really positive relationships and brand experiences, application experiences with a whole variety of other partners that they might work with, right? And so there's a kind of disaggregation between the banks and other sort of infrastructure providers who are really good at providing the underlying service, but maybe not actually providing a good customer experience with that service. And I think this is marvelous because it lets both players really play to their strengths, right? It allows the sort of brands, the applications to deliver a quality experience.
We're competing here, Jay.
And it allows those who have really robust infrastructure to focus on doing that well.
Yeah. What are your thoughts, Raji?
Yeah, no, we completely agree at Klarna. We have 150 million global consumers who are choosing Klarna because it's a fairer and more sustainable way to access credit than some of the traditional legacy banks have provided in the past. And as David alluded, some of these legacy banks, there's not a single bank, UK high street bank, that has a Trustpilot score of above 2, versus Klarna has a Trustpilot score of 4. So I think consumers want to partner with organizations where they feel trust.
Yeah, absolutely. I think one of the speakers on a previous panel, he said something like 60% of SMEs in the UK are currently being banked not by the big 5. So I think that just reflects, to your point. Let's talk a bit about Liberi, Rob, because your basis when you started off was about empowering SME owners by plugging that small business funding gap. What was your strategy in 2007 and how has it evolved?
So, yeah, Liberi as an embedded finance platform started in 2015. And that's when my shareholders bought a book with lots of data of small business lending. And we provided our first partnership with WorldPay to embed our funding into their platform. Now, what happened over those past few years is, small businesses are dealing more and more with ecosystems rather than just a bank. So it's not they have their separate payment provider, a separate bank, a separate credit card provider, a separate integration into e-com platforms like eBay and Amazon, etc. They have one operating system, and that's where we thrive and excel at, is building our embedded finance platform into the mission-critical software for small businesses. Now look at Vagaro, which is, if you go to a hairdresser, it's a high probability that they actually have software running on Vagaro. It deals with the bookings, it deals with the online payments, it deals with the integration into the online platforms, it deals with their accounting software, all in one package. And we actually get all that data, see all that data, and make a pre-approved offer to those merchants in that platform. So every single hour they actually use that platform, and they log on and see a little widget that says, "Dear Rob, you are pre-approved for X amount of for £20,000 of working capital. Click here." Now they take that out. Takes less than 3 minutes, and we collect it as a percentage of their revenues. So the entire integrated journey, the frictionless journey that is there, is what is driving that uptake and that the penetration basically of embedded finance into every single aspect of small businesses.
And can any of you give some examples of embedded finance that even surprised you in its ability to be innovative?
I think the one that caught us off guard was, I mean, we had spent, the better part of the last 7 years going through the bank authorization process, and there were some parts of the FinTech landscape that we knew really well. Payments and wealth being the kind of two main ones. Obviously, I mean, neobanking, spend management, payroll, like a ton there that we could see innovation happening in. What caught us off guard was property, actually. And so, in particular, we've seen huge demand from people who are providing software to estate agents to power things like rental collection flows for managed properties, deposit scheme, sort of payment infrastructure. And it's one of those things where, of course, it makes sense, right? Like your sort of, your corner estate agent is not necessarily like super technologically sophisticated and would like to not have to go through a legacy bank to manage a client money account or all of this stuff. And so we're seeing these sort of very targeted vertical software plays that are providing embedded finance as part of a broader suite of products to that property sector. That's been really cool for us.
Interesting. Raji?
Yeah, sure. So you've seen buy now, pay later adoption very predominantly in retailers and fashion, but what we're seeing a lot now is combination of Klarna or buy now, pay later with use cases or verticals that you wouldn't traditionally expect to see Klarna. So as an example, we power on-demand or subscription services, so being able to offer your monthly gym or newspaper subscription via Klarna, or we partner with the scooter company Voi, where soon with a large mobility player, you'll be able to bundle all of the rides or deliveries you take in a single month and combine it into one single interest-free payment, which actually coincides with your salary payment. So really making it much more flexible and being able to manage it all in one place. Or one of the categories that always makes me laugh is one of the fastest growing categories through Klarna is leaf blowers. So just conveying that it's not just millennials who use buy now, pay later, but actually the fastest age growing segment is 56 and above.
Wow, that doesn't surprise me. David, I want to say congratulations. You recently got your full banking license. No small feat. What does that change for your business?
Yeah, I mean, I feel like two things. I mean, just at a cursory level, like build mode, application mode is very different from actually running a bank and having customers. So I've gone from having sleepless nights over whether the FCA and PRA would approve us to sleepless nights over whether or not our customers are all going to quit, which is much more frightening, actually, weirdly. And then I think the other thing that's really interesting, right, is that over the last couple of years, the landscape economically has changed hugely, right? So we were born in a zero interest rate environment, and obviously we're not in that anymore. Well, sorry, yes, of course. I came into existence in 2017 when the company was incorporated. I didn't exist before then. And that's meant a huge amount of interest in interest-bearing savings accounts on a sort of embedded, white-labeled basis. In ways that are both obvious, so sort of embedded as part of broader kind of financial wellness, financial inclusion platforms, as well as really interesting, less obvious cases, right? So I'm always on kind of Rob's hobby horse of democratizing access to finance and financial inclusion. So one of the things that we've seen that's really cool is credit providers who are serving historically underbanked populations may struggle to get sufficient sort of credit underwriting data to be able to give them a material loan that is, or even revolving line of credit that is commensurate with what the customer is looking for. But if we can work with that lender and provide a savings account as part of that, they can then collateralize the credit line, and so the customer is getting the ability to save, and they're also getting the access to finance that they want and wouldn't be able to have otherwise. So tons of really interesting stuff happening.
That's amazing. And is that in any particular geography that you're looking to roll that out?
We're just UK focused for the moment.
Just UK focused.
We have our international ambitions, but one thing at a time.
Yeah, absolutely. And I mean, in these recent two sessions that we had, had examples of partnerships. Do you think there's a lot of collaboration when it comes to embedded finance?
I mean, absolutely. Our whole business model is built on partnerships, and we actually think retailers are well poised to be successful at embedded finance for a few reasons, but one, it's integrated within the customer experience where the customer is already shopping, and there's a lot of opportunities to continue to expand on loyalty and consumer growth. But again, it also goes back to that trust and making sure that you're partnering with organizations that you really trust.
Are there any examples of embedded finance that haven't worked very well? Rob, can you think of any?
Plenty, I would say.
Yeah.
I think there's more use cases of not working well than it is working well. And that's for multiple reasons. I mean, first of all, look at the consumer. So if there's not a frictionless journey, but you have to go through 10 different pages of filling in your information, you're going to lose your consumer. If you deal with, I'm giving you the example of Vagaro or many of our partnerships like WorldPay, you deal with the WorldPay environment. You don't expect to fill in your information again. You actually, what you expect is, you already have my information, you know everything about me. Where's my product offer? So if you see a handover, to an external kind of website where you still have to fill in all your data, you lose 30 to 50% of your customers already there. Now then, for every single field that you have to fill in, you lose every single field is about between 1 and 3% drop off again.
Really?
So if you have 30 fields that you need to fill in, you basically have no customers left.
Yeah.
So we thrive on embedding ourselves and making it frictionless for merchants. We know everything about you. We have all your information. It is a 4-click journey. You can be done in 3 minutes with money in your account with either same day or within even a few minutes. And every single time that I just applied for a new mortgage, besides the fact that it tripled in rate. It's also like, I had to go through the entire mortgage application again. You got all my details.
Yeah.
Like, why do I have to fill in every single bit again and again and again? So it's between frictionless consumer journey or frictionless application journey, the regulatory side that you need to cover, so KYC, KYB, and what can you automate of that? And then the third point is, that's one of the most important part is, do you have a differentiating offer? Is it speed, convenience, price, availability, or all of the above? And some of these offers that you get are just not, they don't bring anything to you. So why would you go for it?
I think the other side of it too is like respecting consumer behavior, right? So obviously everyone here is trying to bring about the future in one way or another, right? But if you're trying to bring about a future that is critically dependent upon some huge shift in consumer behavior, you really have an uphill battle ahead of you. And so the place where I think we've seen that most significantly is a huge number of companies all trying to issue cards at the same time. And it's like, okay, viewed through your sort of isolated lens, sure, you may think you have a differentiated proposition, you may think you have a kind of right to exist in a consumer's wallet, but the reality is that the consumer is not going to walk around with 20 cards in their wallet. And so that, like writ large, that kind of ecosystem trend doesn't make sense. And so a lot of the places where we get the most excited are where there's like a really concrete demand that's coming from the market, and all we're doing is filling the demand.
Yeah. Do you think, to that point, and just to follow up on that, can the embedded finance market become a bit overcrowded, so consumers are bombarded with, well, you've got this and you've got that, and then as a consumer, you're not going to take all of those options, are you?
Absolutely. I mean, the advent of free money is gone, so you actually now have to have a product that A, makes money, B, is taken up by consumers without throwing 90 pence or selling dollars for 90 cents, basically. I mean, how many here in the audience, or even here on stage probably, have ordered free guerrilla kind of deliveries, all funded by VC money?
Yeah.
That is all gone. So in the embedded finance space, it's the same thing. Like there were hundreds of millions flowing into embedded finance, whether it's embedded payments, finance, lending, you name it. All that is disappearing, and you need to have a business model that not only convinces people that you have the right product and takes a good uptake, but also actually makes some money at the background as well.
So is there going to be some consolidation then in the sector and some big fails, and then we have sort of less offerings around? Is that what's next?
I definitely think so. I think that there's a few things that have made a big change. The first is this device that everyone has and the rise of mobile wallets. But the second is technology. So, You know, at Klarna, we envision a world, you know, maybe 5 years, maybe 10 years, maybe sooner than that, where you get a little ping and it says, you know, I can save 50 pounds on my mortgage, or I can get 3% more on my savings. And we really want that alert to come from Klarna. We think technology has enabled that and allowed banks to charge less on interest and savings. And there will be a consolidation of fewer global banks. So that bank might be Chase, that might be Amazon, but we definitely want it to be Klarna.
Rob. Oh, David, go ahead.
Yeah, I think we will. I think we're already seeing that to some degree. It's quiet, right? I mean, there's been a lot of, I forget what the term is, but just kind of quiet little bridge rounds, investors trying to keep, you know, companies afloat for another year in the hope that interest rates would finally go back down to zero, which I don't think is going to happen anytime soon.
Yeah, sorry, Rob.
Yeah, well, I mean...
No, I'm a big proponent of that.
But I think the other side of that is that I do see the regulatory gate kind of getting a little bit tighter. And I see that here, I see that in the US, I see that in a bunch of markets. And so the other side of this is there are going to be fewer new entrants. And so, you know, fewer new entrants, more companies struggling, I think we will see consolidation and kind of a little bit less, I don't want to say less competition, but maybe less froth. Like I think a little bit of market discipline is healthy.
Yeah, it's inevitable, isn't it? Rob, final thought, because we have to wrap up the panel.
I think, look, between the three companies here, what is really important for society is access to capital. And I was at a conference in the US where the notorious Mike Milken was giving a presentation about the American dream and actually moving from the bottom 20% of earners to the top 20% of earners. The positive mobility, the upward mobility of people and society drives a lot of the well-being in a country, but also the drive of people in a country. And the clear correlation between that was, you know, the countries that had high access or democratized access to finance were also the countries that saw the highest upward mobility in society. And that translated in higher earnings growth, but also higher GDP, healthier and happier people. So we need to really, act upon that democratizing of finance, and companies, the three companies you see on stage here, are doing their fair share.
Absolutely. On that positive note, we shall leave it. Please join me in thanking David, Rob, and Raji. Thank you.
Thank you.
Thank you. Thank you. Thanks.